Most Americans are not broke because they don't work hard. They're struggling because the system is quietly working against their money habits. From credit card debt to student loans, from rising housing costs to healthcare bills, and from inflation to job insecurity, financial pressure in the US isn't just one problem, it's a chain reaction. And here's the truth nobody talks about. You can earn a good income and still feel broke. You can have a full-time job and still live paycheck to paycheck. You can even own assets and still have zero financial freedom. Because wealth in America isn't just about how much you make, it's about how well you survive these 15 real financial traps that quietly affect everyday people. In this breakdown, we're not talking about theory. We're going deep into real financial struggles Americans face every single day, and more importantly, how they actually connect to each other. If you understand these, you won't just manage money better, you'll start thinking like people who actually build long-term financial freedom. Now let's break it down, step by step. Number 1. Why most Americans stay broke even with a good salary. A lot of people in the USA think making more money will automatically solve their financial problems, but the reality is different. Millions of Americans earn decent salaries and still live paycheck to paycheck. The real problem usually isn't income alone, it's lifestyle inflation, debt pressure, and poor money systems. When people get raises, they often upgrade everything at the same time: a newer car, more subscriptions, expensive apartments, eating out more, and higher monthly payments. The paycheck grows, but financial stress stays exactly the same. One of the biggest mistakes beginners make is thinking investing is only for rich people. That's false. Today, almost every major brokerage offers commission-free investing and fractional shares, meaning someone can start investing with as little as $5 or $10. Years ago, trading fees made investing expensive. That's no longer the case for most Americans. Another misunderstanding is keeping too much cash sitting in low-interest savings accounts for years. Inflation slowly destroys purchasing power. If groceries, rent, gas, and healthcare costs rise faster than your savings account grows, your money is effectively shrinking every year. A smarter financial foundation starts with 3 basic priorities: build an emergency fund, eliminate high-interest debt, and invest consistently over time. Many beginners also fall into fast money thinking. Social media constantly pushes luxury lifestyles, crypto hype, meme stocks, and unrealistic success stories. But long-term wealth in America is usually built slowly through consistency, not overnight luck. The stock market itself is simply ownership in businesses. When someone buys shares of a company like Apple or Tesla, they're buying a small ownership stake in those companies. That's very different from gambling. A major financial problem in the USA today is consumer debt dependency. Credit cards make overspending easy. Buy now, pay later services create invisible debt. Car loans stretch for 6 or 7 years. Many Americans look wealthy online while quietly drowning in monthly obligations. The goal of investing should not be getting rich fast. The goal should be buying financial freedom little by little, one investment, one smart decision, and one disciplined habit at a time. Another important correction beginners should understand: stocks do not always go up. Markets rise and fall. Risk is part of investing. That's why diversification matters. Putting all your money into one trendy stock can destroy years of savings if the company collapses. Long-term investors usually focus on broad index funds, low fees, consistent investing, patience during market crashes, emotional control. The Americans who build real wealth often look boring financially. They avoid unnecessary debt, invest monthly, live below their means, and think in decades instead of weeks. One financial trap hurting many Americans today is the illusion of success. Social media makes it look normal to drive luxury cars, vacation constantly, wear designer brands, and trade stocks every day. But behind the scenes, many people are financing their lifestyles with debt instead of actual wealth. A person earning $70,000 a year can still be financially unstable if their rent is too high, their car payment eats up income, credit card balances keep growing, they have no emergency savings, they invest nothing for retirement. Meanwhile, someone earning less may quietly build wealth by controlling expenses and investing consistently. Another major issue is financial illiteracy in the USA school system. Most Americans graduate without learning how taxes work, how credit scores work, how retirement accounts work, how compound interest works, and how investing actually works. Because of that, many people enter adulthood already behind financially. One of the most powerful concepts beginners need to understand is compound growth. Small investments made consistently over long periods can become surprisingly large. For example, this formula represents compound interest. Even modest monthly investing over 20 to 30 years can create major wealth growth. Another miscorrected misconception: diversification does not guarantee profits, it reduces risk. Many beginners think owning multiple stocks automatically makes them safe, but if all the companies are in the same industry, the portfolio can still collapse during economic downturns. That's why many experienced investors prefer diversified index funds that track large sections of the market instead of trying to predict the next hot stock. A serious real-world USA financial problem today is retirement insecurity. Millions of Americans have little or no retirement savings. Many rely heavily on Social Security alone, which often isn't enough to maintain a comfortable lifestyle after retirement. This creates another problem. People delay investing because they think they need large amounts of money to start. In reality, time matters more than starting big. Someone investing small amounts early often beats someone investing larger amounts later because time allows compounding to work longer. Another dangerous beginner mistake is emotional investing. Buying during hype, panic selling during crashes, following influencers blindly, chasing guaranteed returns. Real investing requires emotional discipline. Markets naturally fluctuate. Economic recessions, inflation spikes, layoffs, and market crashes are normal parts of long-term investing cycles. In the USA, healthcare debt is also a massive financial burden. One medical emergency can destroy years of savings. That's why emergency funds matter before aggressive investing. A healthy beginner financial system often looks like this: stable income, emergency savings, employer retirement match if available, pay down toxic debt, invest consistently into diversified assets, increase income over time, stay invested long-term. Wealth building is usually less about intelligence and more about behavior. Consistency beats excitement in personal finance almost every time.
If you're enjoying the video so far, make sure to like, comment, and subscribe right now because more powerful finance tips are coming ahead.
Number 2, the credit card debt crisis destroying middle-class Americans. One of the biggest financial problems in the USA today is credit card debt. Millions of Americans use credit cards not for convenience, but for survival. Rising rent, groceries, insurance, and medical bills have pushed many households into a cycle where they borrow money just to stay afloat. The dangerous part is that credit cards feel harmless at first. Swiping a card takes seconds, but interest quietly compounds every month. Many people only pay the minimum payment, not realizing how long repayment can actually take. A common misconception is thinking minimum payments are good financial management. In reality, minimum payments mostly protect the credit card company, not the customer. Interest continues growing while the actual balance barely moves. Here's the real problem. A small balance becomes a long-term burden. High interest rates destroy cash flow. Debt limits future investing opportunities. Financial stress increases emotionally and mentally. Many Americans also confuse credit score building with unnecessary spending. You do not need to carry debt to build good credit. Responsible usage and on-time payments matter far more than overspending. Another major issue is emotional spending. People often spend money because of stress, depression, social pressure, loneliness, fear of missing out. Retail therapy has become extremely common in the USA. Online shopping apps make impulse spending easier than ever. One-click purchases remove the psychological pain of handing over physical cash. A corrected reality beginners should understand: credit cards are tools, not extra income. Many young adults accidentally treat available credit like free money. Then interest rates above 20% turn manageable purchases into financial disasters. For example, carrying a large balance at high interest creates exponential debt growth over time. This is why small unpaid balances can become massive over several years. Another overlooked USA financial issue is subscription overload. Americans often underestimate recurring monthly expenses: streaming services, food delivery memberships, gym memberships, phone financing, buy now, later payments, app subscriptions. Individually, they seem small, but combined, they destroy monthly budgets. One reason middle-class Americans struggle financially is fixed monthly obligations. Once income becomes fully committed to bills, people lose flexibility. Then a single emergency, job loss, medical issue, or car repair creates instant financial panic. A smarter financial strategy includes paying balances in full whenever possible, keeping credit utilization low, avoiding impulse financing, tracking recurring subscriptions, building emergency savings first. Another important correction: a high income does not automatically mean financial stability. Many high earners carry massive debt loads and have very little actual net worth. Real wealth is about what you keep, not what you spend. Another financial mistake many Americans make is using credit cards to maintain appearances. People often feel pressure to look successful online or keep up with friends, coworkers, and influencers. Expensive dinners, luxury phones, vacations, and designer products are frequently purchased with borrowed money. This creates what financial experts call a debt lifestyle. Income becomes trapped paying for past decisions instead of building future wealth. A dangerous cycle usually looks like this: spend too much, can't fully pay balance, interest gets added, monthly payment increases, more debt gets used to survive. Over time, financial freedom disappears. Another corrected misconception: balance transfers are not magical solutions. Many Americans move debt from one card to another without changing spending habits. The debt may temporarily feel smaller because of promotional interest rates, but the core problem still exists. Behavior matters more than financial tricks. One growing problem in the USA is invisible debt. Buy now, pay later services split purchases into smaller payments, making spending feel harmless. But many people forget how many payment plans they already have active at the same time. When combined with car loans, student loans, rent, insurance, credit cards, the monthly financial pressure becomes overwhelming. Another issue is emergency dependency on credit cards. Many households don't have enough savings to handle medical emergencies, car repairs, temporary unemployment, or home repairs, so the credit card becomes the emergency fund. That's extremely risky because high-interest debt grows faster than most people realize. A healthier system is build emergency savings first, avoid carrying high-interest balances, use credit cards mainly for convenience or rewards, track spending weekly, increase income alongside investing. Many Americans also misunderstand credit scores. A good credit score is useful, but it is not the same thing as being wealthy. Someone can have excellent credit, expensive debt, no investments, no emergency fund, no retirement savings. Financial health is bigger than a 3-digit score. Another major USA financial reality is that wages often struggle to keep up with inflation. Housing, healthcare, insurance, childcare, and groceries have become dramatically more expensive in many states. This forces some families into debt even while working full-time jobs. That's why increasing income matters too. Side businesses,
freelancing, skill development, certifications, career advancement. Cutting expenses alone can only go so far. A practical beginner rule many financially successful Americans follow is, if you can't comfortably pay it off, don't finance it emotionally. Smart investors also avoid chasing fast wealth while carrying toxic debt. Paying 22% credit card interest while trying to earn 8 to 10% investing returns usually makes little financial sense mathematically. Long-term wealth building starts with strong financial habits, not flashy purchases.
Number 3. Why Americans are falling behind because of lifestyle inflation. One of the most overlooked financial problems in the USA is lifestyle inflation. This happens when income increases, but spending rises just as fast or even faster. Instead of building wealth, many Americans upgrade their lifestyles every time they earn more money. A raise at work often leads to a more expensive apartment, a newer car, bigger monthly payments, luxury subscriptions, more dining out, higher credit card spending. The paycheck grows, but financial pressure never disappears. A corrected misconception beginners should understand: making more money does not automatically create wealth. Wealth is built from the gap between income and expenses. If spending rises with every promotion, financial progress slows dramatically. Social comparison makes this worse in America. Many people constantly compare themselves to coworkers, influencers, friends online, celebrities, viral lifestyles on social media. This creates invisible financial pressure to look successful, even when people are struggling privately. One of the biggest examples is car culture in the USA. Many Americans finance vehicles they realistically cannot afford because monthly payments make expensive cars feel manageable. But long-term auto loans can quietly drain thousands of dollars from future investing potential. Another mistake is confusing assets with liabilities. A luxury car usually loses value over time. An investment portfolio has the potential to grow over time. That difference matters financially. Another real issue is housing pressure. In many American cities, people stretch their budgets far beyond safe limits just to live in trendy areas or larger homes. Then rising utilities, taxes, maintenance, and insurance create even more financial stress. Financially successful people often avoid upgrading too quickly after income increases. Instead, they may invest raises, increase retirement contributions, eliminate debt faster, build emergency reserves, buy appreciating assets slowly.
One powerful wealth-building concept is delayed gratification, sacrificing short-term excitement for long-term financial freedom. Many beginners underestimate how much small recurring upgrades affect long-term wealth. Daily coffee spending, constant food delivery, frequent online shopping, subscription stacking, impulse technology purchases. Individually, they seem harmless. Combined over years, they become massive financial leaks. A corrected reality: budgeting is not about restriction, it's about control. People who track their spending usually discover they waste far more money than they originally believed. Another growing USA financial problem is burnout spending. Many workers feel exhausted from stressful jobs and use shopping, vacations, and entertainment as emotional rewards. But emotional spending often creates temporary happiness and long-term financial problems. That's why financial discipline matters more than motivation. Motivation changes daily. Systems and habits create stability. The Americans who quietly build wealth often live below their means long after their income rises.
Another financial trap many Americans fall into is upgrading too many areas of life at the same time. A salary increase feels exciting, so people immediately increase housing costs, car payments, travel spending, entertainment budgets, luxury purchases. But higher monthly obligations reduce flexibility. Once fixed expenses become too large, even a good income can feel stressful. A corrected misconception: financial success is not about appearing rich, It's about building long-term security. Many wealthy people in America actually live far more conservatively than social media suggests. They focus on cash flow, investments, business ownership, retirement accounts, and long-term stability, instead of constantly upgrading lifestyles. Another major issue is the normalization of debt. Financing has become so common that many Americans no longer question monthly payments. Companies market everything in small monthly amounts because it feels psychologically affordable. But multiple small payments eventually create a dangerous financial structure. For example, car payment, phone financing, furniture financing, subscription payments, credit card minimums, buy now, pay later plans. Individually manageable, together overwhelming. Another serious USA financial problem is the lack of savings discipline. Many households spend first and save whatever remains at the end of the month. Financially stable people usually reverse that system. Save first, invest consistently, spend what remains. This approach creates automatic wealth-building habits over time. A useful concept many beginners ignore is opportunity cost. Money spent today loses the chance to grow tomorrow through investing. For example, long-term investing growth can compound dramatically over decades. Even relatively small monthly investments can become substantial over long periods because of compound growth. Another corrected reality: high consumption rarely creates financial independence. Many Americans are financially trapped because their lifestyles require continuous high income just to survive. If income stops temporarily, the entire financial system collapses. That's why emergency funds are critical. A strong emergency reserve creates flexibility, lower stress, better decision-making, protection during layoffs or recessions. Lifestyle inflation also affects investing behavior. Some people delay investing for years because they believe they need more income first, perfect timing, or large starting capital. But consistency matters more than perfection. Another important point: financial freedom usually grows quietly. Debt grows loudly. Wealth building often looks boring from the outside. Automatic investing, long-term patience, controlled spending, avoiding unnecessary debt, living below income level. Meanwhile, overspending often creates temporary excitement, followed by years of financial pressure. The Americans who stay financially strong during recessions are usually the ones who controlled lifestyle inflation before the crisis ever happened. Number 4. The student loan problem keeping millions of Americans financially stuck. One of the biggest financial burdens in the USA is student loan debt. Millions of Americans start adulthood already owing tens of thousands of dollars before they even build savings, buy a home, or invest for retirement. Many students are told the same message: go to college, get a degree, and financial success will automatically follow. But reality is far more complicated. A corrected misconception beginners should understand: not all degrees create the same financial opportunities. Some careers produce strong long-term income. Others leave graduates struggling with low wages, high monthly payments, limited job opportunities, and long repayment timelines. This creates financial pressure during the most important wealth-building years of life. Another major issue is that many teenagers sign large loan agreements without fully understanding interest accumulation, repayment structures, long-term debt impact, delayed investing opportunities. At 18 years old, most people are not financially educated enough to evaluate decades of debt responsibly. Student loans also create a psychological effect. Many Americans delay marriage, having children, buying homes, starting businesses, investing, career changes, because monthly debt obligations reduce financial flexibility. One corrected reality: higher education can absolutely be valuable, but only when the financial return makes sense. Some Americans graduate with expensive degrees
but work in industries where salaries cannot realistically support large debt balances. Meanwhile, tuition costs have increased dramatically over the years, while wages often haven't grown at the same pace.
Another important issue is interest capitalization. Many borrowers think they only owe the original loan amount, but interest can continue growing during deferment or missed payments, causing balances to rise even when payments are being made. Debt growth over time can become mathematically aggressive. This is why long repayment periods can dramatically increase total repayment costs. Another common mistake is lifestyle inflation immediately after graduation. Some people finally receive stable income and quickly increase spending. Luxury apartments, expensive cars, vacations, designer products, while still carrying massive student debt. A healthier financial strategy often includes building emergency savings, paying high-interest debt aggressively, increasing income strategically, investing consistently while repaying debt, and avoiding unnecessary lifestyle upgrades. Another corrected misconception: student loans are not good debt simply because they funded education. Debt should always be evaluated by financial return, career stability, and repayment ability. The emotional side also matters. Many Americans feel shame, stress, or hopelessness because of student debt. Financial pressure affects mental health, relationships, career decisions, and risk-taking ability. That's why financial literacy before borrowing is extremely important.
Another major financial problem in the USA is that many graduates enter the workforce expecting immediate financial stability, but reality hits differently. Entry-level salaries are often much lower than expected, while student loan payments begin quickly. This creates a dangerous financial imbalance: high debt, rising living costs, limited savings, and low investing capacity. Many Americans spend their 20s trying to recover financially instead of building wealth. A corrected misconception: education alone does not guarantee financial success. Skills, income potential, networking, adaptability, and financial discipline matter just as much. Another issue is degree mismatch. Some graduates work in careers completely unrelated to their field of study because job demand changed or opportunities became limited. Meanwhile, the debt remains regardless of career outcome. This leads many borrowers to feel trapped. Another growing problem is private student loans. Unlike many federal loan programs, private loans may offer fewer protections, higher interest rates, and less repayment flexibility. Some borrowers underestimate how aggressive repayment terms can become over time. A smarter approach many financially aware Americans now consider includes community college first, employer-sponsored education, trade schools, in-state tuition, scholarships and grants, and career ROI analysis before borrowing. This doesn't mean avoiding college completely. It means evaluating education like an investment decision instead of an emotional decision. Another corrected reality: prestige does not always equal profitability. An expensive university name does not automatically guarantee higher lifetime earnings. One real-world USA financial issue is that many borrowers prioritize lifestyle before financial recovery. After graduation, pressure to finally enjoy life often leads to luxury apartments, financing expensive vehicles, travel debt, and excessive entertainment spending, while student balances continue growing quietly in the background. Another overlooked problem is retirement delay. Many Americans postpone retirement investing because student loan payments consume too much monthly income. This is dangerous because time is one of the most valuable factors in investing. Long-term investing benefits heavily from time and compounding. Even small monthly investments started early can outperform larger investments started much later. Another corrected misconception: you do not need to completely pause investing while paying student loans. In many cases, balancing debt repayment, retirement contributions, emergency savings can create stronger long-term financial outcomes
than focusing only on one area. Financially successful borrowers often focus on increasing income, living below their means temporarily, avoiding new toxic debt, building valuable career skills, staying consistent financially. Another harsh reality is that some Americans become discouraged and stop planning financially altogether because the debt feels overwhelming. But avoidance usually makes the situation worse. Financial progress often starts small: tracking spending, creating a repayment plan, negotiating expenses, building emergency savings gradually, investing consistently over time. The goal is not perfection. The goal is regaining financial control step by step.
Number 5. Why emergency expenses are financially destroying American families. One of the harshest financial realities in the USA is how quickly a single emergency can destroy years of progress. Many Americans are only one unexpected expense away from serious financial trouble. A medical bill, car repair, job loss, or home emergency can instantly create credit card debt, missed payments, loan defaults, emotional stress, and financial panic. The biggest issue is that millions of households simply don't have enough emergency savings. A corrected misconception: having a high income does not automatically protect someone financially. Many high earners still live paycheck to paycheck because their monthly obligations are too large. When emergencies happen, they have no financial buffer. Another major problem is overdependence on debt during emergencies. Instead of savings, many Americans rely on credit cards, personal loans, payday lending, and buy now, pay later services. This turns temporary emergencies into long-term financial problems because interest keeps growing after the crisis ends. One especially dangerous USA financial issue is payday lending. People facing urgent bills sometimes borrow small amounts of money with extremely high interest rates. What begins as a short-term solution can quickly become a debt cycle that's very difficult to escape. Another corrected reality: emergency funds are not optional for financial stability. They are protection against uncertainty. A strong emergency fund helps people avoid making desperate financial decisions during stressful situations. Most emergencies are not truly unexpected. Cars eventually break down. Jobs can disappear. Medical costs happen over time. Home repairs appear over time. The real surprise is usually being financially unprepared. Another overlooked issue is insurance misunderstanding. Many Americans either lack proper insurance, underestimate deductibles, or ignore coverage gaps. Then, during emergencies, out-of-pocket costs become overwhelming.
A healthy financial system usually includes emergency savings, insurance protection, controlled debt, and flexible monthly expenses. Without those protections, even small disruptions can create financial chaos. Another common mistake is investing aggressively before building basic financial stability. Some beginners focus entirely on stocks, crypto, or fast wealth strategies while having no emergency savings at all. That's risky because emergencies may force them to sell investments at bad times during market downturns. Another corrected misconception: emergency funds should be liquid and accessible. Money needed for emergencies should not be locked into risky investments or difficult-to-access assets. A major USA financial reality is rising healthcare costs. Even insured Americans can face large deductibles, surprise medical bills, prescription expenses, and lost income during recovery. This is one reason financial stress remains extremely high across many households. Emergency preparedness is less about fear and more about stability. Financial resilience allows people to think clearly during difficult moments instead of reacting emotionally.
Another major financial mistake many Americans make is assuming emergencies only happen to other people. Because of that mindset, some households delay savings for years while focusing entirely on spending or lifestyle upgrades. But financial emergencies rarely give warnings. One unexpected event can trigger a chain reaction. Missed bills, late fees, credit score damage, debt accumulation, emotional stress, relationship problems. Financial pressure often affects every part of life, not just money. A corrected misconception: emergency funds are not dead money. Some people avoid saving because they believe every dollar should always be invested, but emergency savings serve a completely different purpose than investing. Investments are for growth. Emergency funds are for protection and stability. Another serious USA financial issue is job insecurity. Even strong industries can experience layoffs, company downsizing, reduced work hours, economic slowdowns. Many Americans underestimate how long it may take to replace lost income during difficult job markets. That's why financial experts often recommend building several months of essential living expenses as a safety buffer. Another overlooked problem is fixed cost overload. Families with extremely high monthly obligations usually struggle the most during emergencies because their required expenses cannot easily shrink. Examples include large mortgage payments, expensive vehicle financing, private school tuition, high insurance costs, luxury apartment leases.
High fixed expenses reduce financial flexibility. Another corrected reality: financial peace often comes from lower obligations, not just higher income. Many financially stable Americans intentionally keep their lifestyles below what they technically can afford because it creates security during uncertain times. Emergency savings also help investors avoid emotional mistakes. During market crashes, people without cash reserves may panic sell investments simply to survive financially. That destroys long-term compounding opportunities. Long-term wealth growth depends heavily on staying invested consistently over time. This becomes difficult when emergencies force people to constantly interrupt investment plans. Another growing USA problem is financial burnout. Some Americans work excessive overtime or multiple jobs without building actual financial security because rising expenses consume nearly all additional income. Without savings, burnout becomes even more dangerous because people feel unable to step away from unhealthy situations. A practical emergency preparedness system often includes emergency savings, controlled monthly expenses, health insurance, disability or income protection, multiple income sources when possible, consistent investing after stability is established. Another corrected misconception: financial preparedness is not pessimism. Preparing for emergencies simply means understanding that uncertainty is part of real life. The Americans who recover fastest from financial setbacks are usually not the people earning the most money. They're often the people who prepared before problems arrived. Small financial habits repeated consistently create long-term resilience. Saving automatically, spending intentionally, avoiding unnecessary debt, building cash reserves gradually, living below income level. Financial security is built before emergencies happen, not during them.
Number 6. Why Americans are struggling financially despite working full-time jobs. One of the most frustrating financial realities in the USA today is that many people work full-time, sometimes multiple jobs, and still struggle financially. Millions of Americans are exhausted, overworked, and stressed, yet feel like they're barely moving forward. A corrected misconception: working harder does not always guarantee financial progress. Income matters, but so do inflation, taxes, debt, housing costs, healthcare expenses, financial habits. Many workers are earning more money than they did years ago, but the cost of living has increased so aggressively that real financial progress feels invisible. Another major USA problem is wage stagnation in certain industries. In many areas, rent increased dramatically, groceries became more expensive, insurance costs rose, healthcare expenses exploded, but wages didn't rise at the same pace. This creates constant financial pressure, especially for middle and lower income households. Another issue is the hidden cost of commuting and work-related expenses. Full-time employment often includes fuel costs, vehicle maintenance,
childcare, work clothing, daily food purchases, and parking fees. These expenses quietly reduce take-home income. A corrected reality? Gross salary and actual financial freedom are not the same thing. Some Americans appear to earn strong incomes on paper while struggling heavily after taxes and expenses. Another major problem is burnout culture. Many workers sacrifice health, sleep, relationships, mental stability just to keep up financially. But chronic stress can eventually reduce productivity, career growth, and long-term earning ability. Another growing issue is dependence on overtime income. Some households build lifestyles that require constant overtime just to survive financially. If overtime disappears, the budget immediately breaks down. That's financially dangerous because unstable income creates unstable planning. A smarter long-term strategy often includes increasing high-value skills, building additional income sources, reducing unnecessary fixed expenses, investing consistently, avoiding lifestyle inflation. Another corrected misconception? Budgeting alone cannot solve every financial problem. While controlling spending matters, increasing earning power is also critical in high-cost economic environments. That's why many financially successful Americans focus heavily on certifications, career advancement, business ownership, freelancing, side income, skill specialization. Income growth combined with disciplined spending creates stronger financial momentum. Another real USA financial problem is productivity without ownership. Many people work extremely hard for decades but never build assets that generate long-term wealth. Assets can include investments, businesses, real estate, retirement accounts, dividend-producing investments. Without ownership, income usually stops when work stops. Another important reality: time is financially valuable. People who begin investing earlier often gain huge advantages because compounding works over long periods. Small, consistent investing habits can eventually outperform irregular large investments made much later. Financial survival and financial freedom are completely different stages. Many Americans are stuck in survival mode because rising expenses constantly consume their income before wealth can grow. Another major financial issue in the USA is that many workers trade almost all of their time for income, but very little of that income actually stays with them. After taxes, rent or mortgage payments, debt payments, healthcare costs, insurance, transportation, groceries, there's often very little left to save or invest. A corrected misconception: being busy is not the same thing as building wealth. Some people work constantly for years but never improve their financial position because their money system is weak. Another growing problem is income instability. Millions of Americans now depend on gig work, contract jobs, freelancing, part-time schedules. While flexibility can be beneficial, inconsistent income often creates financial uncertainty and difficulty planning long-term. This is especially dangerous when people combine unstable income with high fixed expenses. Another overlooked USA financial issue is financial exhaustion. Constant money stress reduces decision-making quality. People under pressure are more likely to overspend emotionally, ignore investing, delay financial planning, accumulate debt, avoid looking at finances entirely. Financial stress becomes both a money problem and a psychological problem. Another corrected reality: wealth building usually requires ownership, not only labor. That's why many financially successful Americans eventually focus on equity investments, business ownership, real estate cash flow, dividend-producing assets, retirement accounts. They understand that relying entirely on active work income can become risky long-term. Another major issue is inflation pressure. Many workers receive raises that look positive initially, but inflation quietly reduces purchasing power over time. For example, higher grocery costs, more expensive healthcare, increased utility bills, rising housing costs can consume raises surprisingly quickly.
Another dangerous trap is reward spending. People working stressful jobs often feel entitled to expensive rewards because they work hard. While occasional enjoyment is healthy, constant emotional spending can quietly destroy financial progress.
A healthier financial system usually balances enjoying life responsibly, investing consistently, controlling debt, and building long-term security. Another corrected misconception: financial freedom is not only about earning more, it's also about reducing dependence on mandatory monthly obligations. People with lower fixed expenses often gain more flexibility, better career options, reduced stress, greater investing ability. Another real-world financial problem is retirement fear. Many workers realize later in life that decades passed without serious investing or retirement preparation. That realization creates panic because time matters enormously in investing growth. Consistent long-term investing allows compounding to accelerate over time. The earlier someone starts, the more powerful compounding becomes. Another important reality: financial independence is usually built slowly and intentionally. Most wealthy Americans did not become financially stable overnight. Many followed disciplined habits for years, living below their means, investing regularly, avoiding toxic debt, increasing income strategically, staying patient during setbacks. Hard work matters, but without financial systems, ownership, and long-term planning, even hard-working people can remain financially stuck for decades.
Number 7. Why retirement fear is growing across America. One of the biggest financial fears in the USA today is retirement insecurity. Millions of Americans are deeply worried that they may never be able to retire comfortably, even after working for decades. A corrected misconception: retirement is not automatically guaranteed after years of working. Many people assume Social Security alone will fully support retirement, but in reality, rising living costs often make that extremely difficult. Another major issue is delayed investing. A large number of Americans wait too long to begin investing because they believe they need a high income first. They need perfect market timing. They need large starting capital. Retirement is far away. But waiting is extremely expensive financially because time is one of the most powerful parts of investing. Compound growth becomes stronger over long periods. Even small investments started early can grow significantly over decades. Another real USA financial problem is retirement lifestyle inflation. Some Americans increase spending heavily during their working years and never build enough assets to support that lifestyle later in life. Retirement planning becomes much harder when debt remains high, savings are low, monthly obligations are large, healthcare costs continue rising. Another corrected reality: retirement success depends more on consistency than perfection. People who invest moderate amounts regularly for long periods often outperform people who constantly try to beat the market emotionally. Another issue is dependency on employer income. Many workers build their entire financial lives around one paycheck without creating investment income, business income, dividend income, additional cash flow sources. This becomes risky later in life because earning ability may decline with age, health problems, or job market changes. Another major concern in America is healthcare costs during retirement. Even people who saved reasonably well may face prescription expenses, long-term care costs, insurance premiums, and unexpected medical emergencies. Healthcare inflation creates major uncertainty for retirees.
A healthier long-term strategy often includes early investing, debt reduction, retirement account contributions, emergency savings, long-term healthcare planning, diversified investments. Another corrected misconception is retirement investing is not only for wealthy people. Today, many Americans can begin investing with small amounts using diversified index funds or retirement accounts. Consistency matters far more than starting perfectly. Another overlooked problem is emotional investing near retirement age. Some people panic during market crashes and sell investments at the worst possible time, damaging years of compounding growth. Long-term investing requires emotional control during both bull markets, bear markets, recessions, and economic uncertainty. Another important USA financial reality is that many Americans support both children and aging parents simultaneously while trying to save for retirement themselves. This financial pressure can delay investing for years. The earlier financial planning begins, the more flexibility people usually have later in life.
Another major financial problem in the USA is that many Americans underestimate how expensive retirement actually is. People often focus only on basic living expenses, but retirement can include healthcare costs, prescription medications, inflation, housing maintenance, insurance premiums, long-term care expenses. Without strong preparation, retirement savings can disappear faster than expected. A corrected misconception: retirement planning is not only about saving money, it's about creating sustainable cash flow. Financially stable retirees usually focus on building assets that can continue producing income over time, such as retirement accounts, dividend-paying investments, real estate income, long-term investment portfolios. Another growing USA issue is late financial awareness. Some people spend decades focused entirely on monthly bills, raising families, career pressure, then suddenly realize in their 40s or 50s that retirement savings are far behind schedule. That realization creates serious financial anxiety. Another corrected reality: starting late is still better than never. Starting early creates huge advantages, but disciplined investing later in life can still significantly improve financial stability compared to doing nothing at all. Another major issue is market fear. Some Americans avoid investing completely because they fear recessions or stock market crashes. But historically, long-term diversified investing has generally outperformed simply holding cash over extended periods. Inflation slowly reduces purchasing power over time when money sits idle. Another overlooked retirement problem is high debt entering retirement years. Carrying credit card debt, large mortgages, vehicle loans, and personal loans into retirement can dramatically increase financial pressure because income often becomes more limited after leaving the workforce. A stronger retirement strategy often includes reducing toxic debt early, increasing retirement contributions consistently, diversifying investments, building emergency reserves, and controlling lifestyle inflation. Another corrected misconception: retirement investing does not require constant stock trading. Many successful long-term investors focus on simplicity, low fees, diversification, and long-term consistency instead of trying to predict short-term market movements. One powerful retirement concept is recurring long-term investing. This formula demonstrates how regular contributions can compound substantially over time. Another major USA financial reality is longevity risk. Americans are living longer in many cases, which means retirement savings may need to support decades of living expenses. This makes early preparation increasingly important. Another corrected reality: financial freedom in retirement is usually built quietly during working years. The Americans who retire most comfortably often spent decades investing consistently, living below their means, avoiding unnecessary debt, increasing income strategically, staying patient during market volatility. Retirement security rarely comes from one lucky investment. It usually comes from disciplined financial behavior repeated consistently over many years.
Friends, if you've learned something from this video so far, give it a like, share your opinion in the comments, and subscribe to stay with us.
Number 8. Why Americans keep losing money chasing get-rich-quick trends. One of the fastest growing financial problems in the USA is the obsession with getting rich quickly. Social media constantly promotes viral stock picks, crypto hype, day trading lifestyles, luxury influencer content. easy money business models. This creates unrealistic expectations, especially for beginners. A corrected misconception: real wealth is usually built slowly, not instantly. Most financially successful Americans built wealth through long-term investing, business growth, consistent saving, career advancement, and asset ownership, not overnight luck. Another major issue is emotional investing. Many beginners buy investments based on fear of missing out, internet hype, celebrity influence, viral trends, and online communities, instead of understanding the actual business or investment itself. This often leads to buying at extremely high prices during hype cycles and panic selling during crashes. Another dangerous USA financial problem is confusing speculation with investing. Investing usually focuses on long-term value, business fundamentals, cash flow, diversification, and risk management. Speculation often focuses on hype, momentum, short-term price movement, and emotional excitement. There's a huge difference financially. Another corrected reality: high returns usually come with high risk. Many beginners only focus on potential profits while ignoring the possibility of major losses. Markets do not move upward forever. Economic downturns, crashes, and corrections are normal parts of investing. Another issue is social media survivorship bias. People online constantly show winning trades, luxury lifestyles, huge profits, but rarely show losses, debt, failed investments, tax consequences, and financial stress. This creates distorted expectations about investing success. Another major USA problem is gambling-style trading behavior. Some people treat investing platforms like casinos, making impulsive decisions without research, risk management, diversification, or long-term strategy. That behavior can destroy savings very quickly. A healthier financial strategy often includes long-term investing, broad diversification, emergency savings, consistent contributions, and emotional discipline. Another corrected misconception: you do not need to constantly trade to build wealth. Many successful investors actually invest passively over long periods instead of making emotional daily trades. Another overlooked issue is tax consequences. Frequent trading can create short-term capital gains taxes, complex reporting, and unexpected tax bills. Many beginners focus only on profits without understanding after-tax outcomes. Another important investing reality is that volatility is normal. Prices naturally move up and down over time. Long-term compound growth depends heavily on patience. Trying to constantly chase the next big thing often interrupts consistent long-term investing habits. The Americans who quietly build wealth usually focus more on discipline than excitement. Another major financial problem in the USA is the illusion that fast money equals financial intelligence. During market booms, many beginners mistake temporary luck for investing skill. When prices rise quickly, almost everyone feels like an expert. But real investing discipline becomes visible during downturns and market crashes. A corrected misconception: a rising market does not automatically mean someone is a skilled investor. Many people take excessive risks during hype cycles without fully understanding valuation, risk exposure, market psychology, diversification, and liquidity. Then, when prices collapse, panic replaces confidence almost instantly. Another growing issue is influencer-driven investing. Some online creators promote aggressive trading strategies while earning money mainly from sponsorships, affiliate links, courses, and advertising revenue. Meanwhile, followers often absorb the financial risk themselves. Another corrected reality: if an investment opportunity sounds unbelievably easy, it usually carries hidden risk. Real investing typically requires patience, research, risk management, long-term consistency, not emotional excitement. Another serious USA financial problem is leverage misuse. Some traders borrow money to increase investment positions, hoping for larger profits. While leverage can magnify gains, it can also magnify losses extremely fast. In volatile markets, leveraged positions can wipe out accounts quickly. Another overlooked issue is emotional decision-making during volatility. Human psychology naturally pushes people to buy during excitement, sell during fear. But financially successful investors usually try to do the opposite. Stay rational during hype, stay patient during panic. That emotional discipline is difficult, but extremely important. Another corrected misconception: diversification does not eliminate losses completely. Diversification mainly reduces concentration risk. Markets can still decline broadly during recessions or economic crises. A healthier long-term investing system often includes emergency savings first, controlled debt, diversified investments, consistent contributions, long-term thinking, and realistic expectations. Another growing USA issue is comparison culture. Beginners constantly compare themselves to people posting huge trading wins, expensive lifestyles, viral success stories. This creates pressure to take reckless financial risks just to catch up. But many online success stories are incomplete or exaggerated. Another important reality: financial freedom is rarely built through constant emotional reactions. Long-term wealth usually grows from consistency, patience, controlled risk, asset ownership, compounding over time, and recurring investing over long periods can create powerful results. Another corrected misconception: missing one investment trend does not ruin your future. Many beginners feel panic when they miss a rapidly rising stock or crypto asset. But constantly chasing trends often leads to buying emotionally near market peaks. The Americans who build sustainable wealth usually focus less on hype and more on financial systems that work consistently for decades. Number 9. Why housing costs are crushing the American middle class. One of the biggest financial problems in the USA today is the rising cost of housing. Millions of Americans are spending such a large percentage of their income on rent or mortgages that they struggle to save, invest, or build long-term wealth. A corrected misconception: owning an expensive house does not automatically mean financial success. Many households appear wealthy on the outside, but are financially stressed because housing costs consume most of their monthly income. Another major issue is rent inflation. In many American cities, rent prices have increased dramatically over the last several years, while wage growth has not kept pace for many workers. This creates serious pressure on young adults, middle-class families, single-income households, and retirees. Many people are forced to delay investing, homeownership, emergency savings, retirement planning, because housing costs dominate their budgets. Another dangerous USA financial problem is buying more house than someone can realistically afford. Some buyers focus only on whether they can qualify for a mortgage instead of whether the payment fits comfortably within their long-term financial goals. A mortgage payment is only part of the real cost. Homeownership can also include property taxes, insurance, maintenance, repairs, HOA fees, utility costs. Those expenses add up quickly. Another corrected reality: a home can be both a lifestyle decision and a financial decision. Not every house automatically becomes a strong investment, especially if buyers stretch themselves financially just to purchase it. Another growing issue is interest rate pressure. Rising mortgage rates increase monthly payments significantly, making homes less affordable even when home prices stay similar. This has pushed many Americans into difficult financial situations, where down payments are hard to save, monthly payments feel overwhelming, housing competition remains intense. Another major problem is lifestyle comparison. Social media and online culture constantly promote luxury homes and expensive living spaces, causing some people to feel pressured into overspending just to match appearances. A healthier financial strategy often includes buying below maximum affordability, keeping emergency savings, avoiding excessive debt, maintaining investing consistency, and leaving room for unexpected expenses. Another corrected misconception: renting is not always throwing money away. In some situations, renting can provide flexibility, lower maintenance risk, reduced financial pressure, and better mobility for career opportunities. The smarter choice depends on overall financial stability, not social pressure. Another important USA financial reality is that housing costs affect investing ability directly. The more income consumed by housing, the less money remains available for retirement investing, emergency funds, debt reduction, asset building, and long-term wealth. Long-term wealth often grows from balancing housing costs with investing discipline. Compounding becomes more powerful when people consistently invest over long periods. Housing should support financial stability, not destroy it.
Another major financial issue in the USA is that many Americans underestimate the long-term pressure of high housing payments. A mortgage or rent payment that feels manageable today can become stressful later when inflation rises, income changes, unexpected expenses appear, interest rates increase, job situations change, financial flexibility disappears quickly when housing consumes too much income. A corrected misconception: the bank's approval amount is not the same as a safe budget. Lenders determine what people may qualify for financially, but that doesn't always mean the payment fits comfortably into a healthy, long-term financial plan. Another growing USA problem is housing-related lifestyle inflation. Some buyers feel pressure to purchase larger homes because of social comparison, family expectations, online culture, status signaling. But larger homes often bring higher taxes, more maintenance, expensive repairs, increased utility bills, furniture costs. The monthly financial burden quietly grows over time. Another corrected reality: financial peace is often worth more than a bigger house. Many financially stable Americans intentionally choose homes below their maximum affordability so they can invest consistently, save aggressively, travel responsibly, handle emergencies comfortably, without constant financial stress. Another major issue is hidden maintenance costs. Many first-time buyers focus heavily on the purchase price, but underestimate ongoing expenses such as roof repairs, HVAC replacements, plumbing issues, appliance failures, landscaping, insurance increases. Home ownership can become financially overwhelming without proper preparation. Another serious USA financial problem is being house poor. This happens when someone owns a home but has very little leftover money for investing, emergency savings, retirement planning, daily financial flexibility. From the outside, they may appear successful, but internally they remain financially fragile. Another corrected misconception: real estate values do not always rise rapidly forever. Housing markets can slow down, stagnate, or decline depending on interest rates, economic conditions, local job markets, population shifts. That's why buying primarily from emotional excitement can become risky. A healthier financial system usually balances affordable housing costs, emergency savings, retirement investing, debt control, and flexible monthly expenses. Another overlooked problem is mobility limitation. Extremely expensive housing can trap people in jobs they dislike because leaving the income becomes financially impossible. Lower financial obligations often create more career flexibility, less stress, greater investing ability, and better long-term stability. Another important reality: housing is usually a long-term financial commitment, not a short-term emotional purchase. Strong financial decisions often prioritize sustainability over appearance. Long-term investing discipline still matters heavily even while managing housing costs. The Americans who build lasting wealth often avoid overspending on housing so they can continue consistently investing for decades. Number 10. Why healthcare costs are financially destroying many Americans. One of the most serious financial problems in the USA is the rising cost of healthcare. Millions of Americans fear medical bills almost as much as losing their jobs because one health emergency can create years of financial pressure. A corrected misconception: having health insurance does not always mean healthcare is affordable. Many Americans still face high deductibles, expensive prescriptions, out-of-pocket costs, surprise medical bills, limited coverage, even while paying large monthly insurance premiums. Another growing USA issue is medical debt. Many families fall into debt not because of irresponsible spending, but because of emergency surgeries, hospital stays, chronic illnesses, specialist treatments, unexpected diagnoses. Healthcare expenses can appear suddenly and completely disrupt financial stability. Another corrected reality: an emergency fund is not only for job loss, it can also protect against medical crises. Without savings, people often rely on credit cards, personal loans, borrowing from family, retirement withdrawals to survive unexpected healthcare expenses. Another major financial problem is prescription inflation. Some medications in the USA cost dramatically more than many people expect, especially for individuals managing long-term health conditions. These recurring expenses can quietly consume large portions of monthly income. Another overlooked issue is delayed medical care. Some Americans avoid doctor visits, preventive care, necessary treatments because they fear the cost. Ironically, delaying treatment can sometimes create even larger medical expenses later. Another corrected misconception: a high income does not automatically protect someone from healthcare-related financial stress. Even middle-class or higher-income families can struggle financially after major surgeries, long-term illnesses, insurance disputes, or extended recovery periods. Healthcare costs can escalate extremely fast. Another serious USA problem is job-linked insurance dependence. Many Americans stay in stressful or unfulfilling jobs primarily because they fear losing employer-sponsored healthcare coverage. This creates both financial and emotional pressure. A healthier long-term financial strategy often includes emergency savings, health insurance evaluation, preventive health care, debt management, and long-term financial planning. Another corrected reality: preventive care is often financially smarter than emergency care. Routine checkups and early treatment may help reduce larger healthcare expenses over time. Another major issue is retirement healthcare planning. Many people underestimate how expensive healthcare can become later in life, especially during retirement years. Medical inflation often rises faster than general inflation. Healthcare expenses can significantly impact retirement savings over time. This is why long-term financial planning must include future healthcare costs, not just monthly living expenses. The Americans who maintain stronger financial stability often prepare for both economic emergencies and medical emergencies simultaneously. Another major financial problem in the USA is that medical expenses are often unpredictable. Unlike normal monthly bills, healthcare costs can appear suddenly without warning and create long-term financial damage within weeks. One unexpected accident or illness can impact savings, credit scores, retirement plans, investment contributions, and household stability. A corrected misconception: good physical health today does not guarantee low medical expenses tomorrow. Many financially stable families become overwhelmed after emergency room visits, specialist procedures, long-term rehabilitation, chronic disease treatment. Healthcare uncertainty is one of the biggest financial risks Americans face. Another growing USA issue is high-deductible insurance plans. While monthly premiums may appear lower, many people still struggle to afford the deductible itself before insurance meaningfully helps cover costs. As a result, some Americans delay treatment because they cannot afford upfront expenses. Another corrected reality: insurance reduces risk, but it does not eliminate financial exposure completely.
Understanding deductibles, copays, coverage limits, and out-of-pocket maximums is extremely important for long-term financial planning. Another serious problem is healthcare-related bankruptcy pressure. Medical debt can accumulate rapidly, especially when combined with job interruption, reduced income, ongoing treatment, and family caregiving responsibilities. Financial stress often increases emotional stress at the same time. Another overlooked issue is mental health expenses. Therapy, counseling, and psychiatric care can become expensive depending on insurance coverage and provider availability. Many Americans struggle silently because financial limitations reduce access to consistent mental health care. Another corrected misconception: healthcare planning is not only for older adults. Young adults also face financial risk from injuries, accidents, sudden illness, mental health challenges. Financial preparation matters at every age.
Another major USA financial issue is caregiving costs. Families caring for aging parents or relatives often experience reduced work hours, increased expenses, emotional exhaustion, delayed retirement planning. Caregiving responsibilities can heavily affect household finances over time. A stronger financial system usually includes emergency savings, health insurance understanding, debt reduction, preventive health care, long-term investing, flexible monthly budgeting. Another important reality: financial stability and physical health are deeply connected. Medical stress can affect work performance, income stability, emotional well-being, and long-term financial decisions. Healthcare inflation also creates major retirement pressure over time. Consistent long-term investing may help create more financial flexibility later in life when healthcare costs increase. The Americans who stay financially resilient often prepare for uncertainty instead of assuming everything will always go according to plan.
Number 11. Why credit card debt is quietly breaking American households. One of the most widespread financial problems in the USA is credit card debt. It often starts small, but over time it becomes a serious burden that affects monthly budgets, savings, and long-term financial stability. A corrected misconception: credit cards are not free money. They are short-term loans with very high interest rates if not paid in full. Many Americans fall into debt because they rely on credit for daily expenses, pay only minimum payments, ignore interest accumulation, use credit to maintain lifestyle spending, don't track monthly balances carefully. Another growing issue is interest compounding. Credit card interest can quietly grow debt even when people think they are managing it. Small balances can turn into long-term financial stress if not addressed early. Another corrected reality: minimum payments are designed to keep you in debt longer, not to clear the debt quickly. When only minimum payments are made, interest builds faster than principal reduces. Total repayment cost increases significantly. Debt payoff timelines stretch for years. Another major USA financial problem is emergency spending reliance on credit cards. Many households use credit cards for medical emergencies, car repairs, rent shortages, unexpected travel, job loss periods. Without an emergency fund, credit becomes the default survival tool. Another overlooked issue is psychological spending behavior. Credit cards make spending feel less painful compared to cash, which increases the likelihood of overspending. A healthier financial strategy often includes paying full balance monthly, tracking spending categories, building emergency savings, limiting unnecessary credit usage, setting strict monthly budgets. Another corrected misconception: having a high credit limit does not mean you're financially secure. In reality, higher limits can sometimes increase overspending risk if discipline is weak. Another important reality is credit score dependency. In the USA, credit scores affect loan approvals, mortgage rates, apartment rentals, insurance premiums, even job applications in some cases. So mismanaging credit card debt can create long-term consequences beyond just interest payments. Another major issue is lifestyle inflation funded by credit. Many Americans upgrade their spending habits before their income actually supports it, creating a cycle of debt dependency. Over time, this reduces financial flexibility and increases stress. Long-term wealth building becomes difficult when monthly income is already consumed by debt repayments. Simple compounding shows how debt grows when unmanaged. This is why controlling debt early is one of the most important financial decisions a person can make. Americans who avoid long-term credit card debt usually focus on discipline, budgeting, and building savings before increasing lifestyle spending. Another major issue with credit card debt in the USA is how easily it hides inside everyday life. Many people don't feel the financial damage immediately because payments are split into small monthly amounts, which creates a false sense of control. A corrected misconception. If you can afford the monthly payment, it does not mean you can afford the debt. The real burden comes from total balance owed, interest rate accumulation, length of repayment period, and ongoing new spending on the card. Another growing problem is balance stacking across multiple cards. Many households don't just carry one credit card balance, they carry several at the same time, each with different interest rates and payment cycles. This creates confusion and often leads to missed payments or inefficient repayment strategies. Another corrected reality. Managing multiple debts without a clear plan increases total interest paid over time. A structured repayment approach usually focuses on paying high-interest debt first, avoiding new credit usage during payoff, consolidating or organizing balances strategically, building a strict monthly repayment plan. Another serious USA issue is emotional spending through credit. Many people use credit cards not just for necessity, but for stress relief, impulse purchases, social pressure, rewarding themselves behavior, emotional instability periods. This turns credit into a psychological tool instead of a financial tool. Another overlooked problem is promotional debt traps. Some cards offer 0% introductory APR, rewards points, cash back offers, but many users fail to pay off balances before promotional periods end, causing sudden high interest charges later. Another corrected misconception. Rewards and cashback do not matter if you carry a balance. Interest payments often outweigh any benefits earned from credit card rewards programs. Another major issue is minimum payment illusion. Credit card statements often highlight the minimum payment prominently, making it feel like a safe option, but in reality, it extends debt timelines significantly. Another important reality is debt snowball effect. Once multiple debts exist, interest payments reduce available cash flow, which increases reliance on credit again, creating a repeating cycle. Breaking that cycle usually requires emergency savings, budget discipline, debt repayment strategy, reduced credit dependency, and controlled lifestyle spending. Another corrected misconception. Credit card debt is not just a financial issue. It often becomes a long-term behavioral issue. Financial recovery requires changing spending habits, not just paying balances. Over time, eliminating credit card debt frees up income that can be redirected toward investing and wealth building. Americans who successfully escape credit card debt usually focus less on credit limits and more on financial discipline and long-term stability. Number 12. Why student loan debt is delaying financial freedom in the USA. One of the biggest financial burdens in the United States today is student loan debt. Millions of Americans start their careers already carrying tens of thousands of dollars in repayment obligations, which slows down wealth building from the very beginning. A corrected misconception. A college degree does not automatically guarantee financial success or high income. Many graduates face low starting salaries, high monthly loan payments, delayed life milestones, limited savings capacity, postponed investing plans. Another major issue is the mismatch between education cost and job return. In many cases, students take large loans without fully understanding future earning potential, job market demand, industry competition, and regional salary differences. This creates financial pressure immediately after graduation.
Another corrected reality. The value of education depends heavily on cost versus income outcome. Some degrees provide strong return on investment, while others may take many years to financially justify the debt. Another growing USA problem is long-term repayment timelines. Student loans can last 10 years, 20 years, sometimes even longer depending on deferment or income-based plans. This long-term obligation reduces financial flexibility for young adults. Another serious issue is delayed wealth building. While peers in other countries or without debt may begin investing early, saving aggressively, buying assets, student loan borrowers often focus first on repayment instead of investment growth. This delay has a compounding effect on lifetime wealth. Another corrected misconception. Minimum payments on student loans do not mean the debt is under control. Interest accumulation can still extend repayment duration significantly, depending on loan type and rate. Another major USA financial issue is lifestyle delay. Student loan debt often pushes people to postpone homeownership, marriage or family planning, entrepreneurship, career risk-taking, because financial pressure limits flexibility. Another overlooked issue is income-based repayment confusion. While these programs can reduce monthly payments, they may also extend total repayment time, increase total interest paid over time, create long-term dependency on debt structures. A healthier financial approach often includes choosing education based on ROI, avoiding unnecessary borrowing, paying extra when possible, starting investing early when feasible, building emergency savings. Another corrected reality, student loan debt is not just a financial burden, it also affects career freedom. People may choose higher-paying jobs but less fulfilling jobs simply to manage repayment obligations. Over time, this debt can delay the natural compounding effect of early investing. Americans who manage student loans strategically often focus on balancing repayment with early financial planning instead of delaying everything until debt is fully cleared.
Another major problem with student loan debt in the USA is how it limits financial confidence in early adulthood. Many graduates enter their 20s already feeling behind, which influences their decisions for years. A corrected misconception: being in student debt does not mean you are permanently financially stuck. However, without a clear strategy, it can slow progress significantly. Another growing issue is repayment pressure combined with low early career income. Entry-level jobs often come with limited salary growth at the beginning, high living costs in major cities, competing financial priorities, and lack of emergency savings. This combination makes debt feel heavier than it actually is. Another corrected reality: income growth over time can change the debt burden, but only if financial planning is done properly. Another serious USA issue is career restriction due to debt. Many graduates avoid lower-paying passion careers, startup opportunities, further education, risk-based career changes, because monthly repayment obligations feel non-negotiable. Another overlooked problem is interest capitalization. In some loan structures, unpaid interest can be added to the principal balance, increasing the total repayment amount over time if not managed carefully. This creates a cycle where the total debt grows even during periods of partial payment or deferment. A corrected misconception: making minimum payments does not always reduce the debt in a meaningful way. Depending on interest rates, payments may primarily cover interest instead of reducing principal.
Another major USA financial issue is lack of early repayment strategy. Many borrowers focus only on meeting monthly obligations instead of planning extra principal payments, refinancing opportunities, interest reduction methods, budget optimization. Without strategy, repayment becomes much longer than necessary. Another important reality is delayed investing. Student loan repayment often prevents young adults from taking advantage of compound growth early, building diversified portfolios, contributing to retirement accounts consistently. This delay has a long-term impact on total lifetime wealth accumulation. A simple long-term growth concept shows how early investing matters. Another corrected misconception: paying off student loans is important, but completely ignoring investing for many years can also reduce long-term financial strength. A balanced strategy often includes consistent loan repayment, small but early investing contributions, emergency fund building, budget discipline, and income growth focus. Another key reality: financial freedom is not only about removing debt, it is also about building assets at the same time. Americans who manage student loans effectively often avoid emotional decisions and instead focus on structured financial planning over time.
Number 13. Why inflation is quietly reducing the purchasing power of Americans. One of the most underestimated financial problems in the USA is inflation. Even when people feel like they're earning more money over time, their actual buying power may not be increasing at the same rate. A corrected misconception: a higher salary does not always mean you are getting richer. If prices rise faster than income, people can still feel financially pressured even with pay increases. Another major issue is the slow and invisible nature of inflation. Unlike sudden expenses, inflation gradually increases the cost of groceries, rent and housing, transportation, healthcare, and utilities. Because the change is gradual, many people don't notice its long-term impact. Another corrected reality: inflation affects savers more than investors. Money kept idle in cash or low-interest accounts often loses value over time in real purchasing power. Another growing USA problem is wage stagnation in certain industries. While some sectors see strong salary growth, many middle-income jobs do not keep up with rising living costs, creating financial pressure for households. Another serious issue is lifestyle inflation. As income increases, many Americans increase their spending on better housing, new vehicles, dining and entertainment, subscriptions and services. This often cancels out potential savings growth. Another corrected misconception: saving money alone is not enough to beat inflation. Without investment growth, long-term savings can lose purchasing power.
A healthier financial approach often includes consistent investing, diversified portfolios, emergency savings, controlled lifestyle spending, and income growth strategies. Another important reality is that inflation impacts long-term goals like retirement planning, college savings, home ownership affordability. Even small percentage changes in inflation can significantly affect long-term financial plans. A simple way to understand long-term value change. Another corrected misconception: inflation is not always bad. It is a normal part of a growing economy, but it must be managed through smart financial planning. Americans who stay financially stable during inflation usually focus on building assets that grow faster than the cost of living.
Another major issue with inflation in the USA is that it affects essential expenses more aggressively than discretionary spending. That means the things people cannot avoid, like housing, food, and healthcare, often rise faster than income. A corrected misconception: inflation does not impact everyone equally. Different households feel inflation differently depending on income level, location, spending habits, debt levels, job stability, and so on. Another growing problem is hidden inflation through shrinkflation. Many products stay at similar prices but reduce quantity, quality, or service value, so consumers pay the same but receive less over time. Another corrected reality: inflation reduces financial flexibility even when budgets look unchanged on paper. Many Americans only realize the impact when savings stop growing, emergency funds feel insufficient, monthly expenses feel tighter, and lifestyle adjustments become necessary. Another serious USA issue is reliance on fixed income during inflation periods. Retirees are especially affected because income may remain stable, but expenses continue increasing. Healthcare costs rise faster than average inflation. This creates long-term financial stress in retirement years. Another overlooked issue is debt and inflation interaction. Inflation can sometimes reduce the real value of fixed-rate debt over time, but it also increases living costs, making repayment harder in the short term. So the overall impact depends on individual financial structure. Another corrected misconception: holding cash during inflation is a losing strategy over long time periods. Cash loses purchasing power when interest rates are lower than inflation. Money is not invested, savings remain idle for long durations. Another major USA financial problem is underestimating compounding needs. To stay ahead of inflation, many investors rely on long-term growth assets rather than cash savings alone. A basic long-term growth model. Another important reality is that inflation forces better financial habits. It encourages people to track expenses more carefully, invest consistently, improve income streams, avoid unnecessary debt, focus on long-term planning. Another corrected misconception: beating inflation is not about timing the market, it's about staying consistently invested over time. Americans who manage inflation successfully usually build systems that increase income and assets faster than the cost of living.
Number 14. Why job insecurity is becoming a major financial fear in the USA. One of the growing financial problems in the USA is job insecurity. Even people with stable jobs often feel uncertain about how long their income will remain consistent due to layoffs, automation, and economic shifts. A corrected misconception: having a full-time job does not guarantee long-term financial stability. Many workers face sudden layoffs, company restructuring, outsourcing of jobs, industry automation, reduced working hours. Another major issue is the rise of income instability culture. Even traditional jobs are no longer as predictable as they once were, especially in fast-changing industries like tech and retail. Another corrected reality: financial security is not only about how much you earn, but also how stable that income is. Another growing problem in the USA is dependency on a single income source. Many households rely on one paycheck, which creates high vulnerability if that income suddenly stops. This risk becomes even more serious when combined with no emergency savings, high debt obligations, high housing costs, and credit dependency. Another important issue is the emotional impact of job insecurity. Financial stress often leads to anxiety, reduced productivity, poor financial decision-making, and fear-based career choices. This creates a cycle where financial pressure affects performance, which can increase job risk. Another corrected misconception: higher income jobs are not always safer jobs. Some high-paying industries also come with volatile markets, frequent layoffs, performance-based job security, and high competition. Another major USA financial issue is lack of emergency preparation. Many people underestimate how quickly income can stop, even in stable careers. A healthy financial system usually includes emergency savings 3 to 6 months minimum, diversified income sources, low unnecessary debt, continuous skill development, budget flexibility. Another important reality is that job insecurity affects long-term planning. People become hesitant to invest consistently, make long-term commitments, take calculated career risks, and spend on education or skill growth. Over time, this slows financial progress. A simple principle of financial stability. Another corrected misconception: relying only on a paycheck is riskier today than in previous decades. Modern financial stability often depends on combining income security, savings discipline, investment growth, skill adaptability, multiple income streams. Americans who prepare for job insecurity tend to recover faster during economic downturns
and maintain stronger long-term financial stability.
Another major issue with job insecurity in the USA is how quickly financial pressure builds once income is interrupted. Even a short gap between jobs can create serious stress if someone is not financially prepared. A corrected misconception: unemployment risk is not only about being fired, it also includes reduced hours, contract endings, and unpredictable gig income. Many Americans experience instability from contract-based work ending suddenly, freelance income fluctuations, seasonal job changes, commission-based pay drops, reduced overtime opportunities. Another growing problem is weak financial buffering. Without savings, even a small income disruption forces people to rely on credit cards, personal loans, retirement withdrawals, or borrowing from friends or family. This often turns a temporary problem into long-term debt. Another corrected reality: emergency savings are not optional. They are a core part of income protection. Another serious USA issue is career concentration risk. Many workers depend entirely on one company, one industry, or one skill set. If that industry slows down, their income becomes vulnerable. This risk is increasing due to automation replacing repetitive tasks, AI changing job structures, global outsourcing, and rapid industry disruption. Another overlooked issue is delayed career adaptation. Some workers do not upgrade their skills until job loss happens, which makes recovery slower and financially painful. Another corrected misconception: job security is no longer guaranteed by tenure alone. Modern job stability depends more on skill relevance, adaptability, industry demand, and continuous learning. Another major financial issue is fear-based decision-making. When people feel insecure about jobs, they often avoid changing careers even if better opportunities exist. Stay in low-growth positions too long. Underinvest in education or skill upgrades. Accept lower long-term income potential. Another important reality is that job insecurity directly affects investment behavior. People often reduce investing during uncertain times, which slows long-term wealth growth. A stronger financial strategy usually includes emergency savings foundation, multiple income sources, continuous skill development, controlled debt levels, long-term investing consistency. Another corrected misconception: income stability matters as much as income size. Someone earning less but with stable income and good financial habits can sometimes be more secure than a high earner with unstable employment. Job insecurity also reinforces the importance of compounding wealth over time. Americans who prepare early for job instability tend to experience less financial damage and recover faster during economic downturns.
Number 15. Why emergency savings is the most ignored financial habit in the USA. One of the most overlooked financial problems in the USA is the lack of emergency savings. Many Americans are financially stable on paper, but only one unexpected expense away from serious financial stress. A corrected misconception: a steady income does not replace the need for savings. Even people with good jobs often struggle when unexpected costs appear, such as medical emergencies, car breakdowns, job loss, home repairs, family emergencies. Another major issue is living paycheck to paycheck. A large number of households spend almost all their income each month, leaving very little room for financial shocks. This creates a cycle where any emergency leads to debt. Debt leads to interest payments. Interest reduces future savings capacity. Financial stress increases over time. Another corrected reality: emergency savings are not about investing. They are about financial survival. Unlike investments, emergency funds are designed to be safe, liquid, and easily accessible, low risk. Another growing USA problem is underestimating small expenses. Many people think emergencies are rare, but financial pressure often comes from smaller, repeated events rather than one big crisis. For example, medical copays, unexpected bills, appliance replacements, travel for urgent situations. Another important issue is financial overconfidence. Some individuals believe they can handle anything without savings, but real-life emergencies often happen at the worst possible time. Another corrected misconception: credit cards are not a substitute for emergency funds. Using credit during emergencies often leads to high-interest debt, long repayment cycles, reduced financial flexibility. A strong financial foundation usually includes emergency fund, minimum 3 to 6 months, stable budgeting habits, controlled debt usage, consistent income planning. Another important reality is that emergency savings reduce financial anxiety. People with savings tend to make calmer and more rational financial decisions during crises. A simple long-term financial growth concept. Americans who prioritize emergency savings early often avoid long-term debt traps and maintain better control over their financial future. Another major issue in the USA is that many people only think about emergency savings after a crisis has already happened. By that time, the financial damage is usually already done. A corrected misconception: emergency savings are not something you build after problems appear. They are built to prevent problems from becoming disasters. Another growing problem is low savings discipline. Even when people know they should save, they often delay it because of monthly lifestyle expenses, debt payments, subscriptions and commitments, short-term spending habits, a lack of budgeting structure. Over time, this delay becomes years of no financial buffer. Another corrected reality: small, consistent savings matter more than waiting for large contributions later. Many Americans underestimate how powerful even small automatic savings can become over time when done consistently. Another serious USA financial issue is emergency dependency cycles. Without savings, people often rely on high-interest credit cards, payday loans, borrowing from family and friends, or retirement account withdrawals. These solutions solve short-term problems but create long-term financial pressure. Another overlooked issue is job interruption vulnerability. Even a short break in income can create serious stress when there is no backup fund available. This becomes more dangerous when combined with rent or mortgage obligations, medical expenses, existing debt payments, and family responsibilities. Another corrected misconception: emergency savings are not idle money, they are financial protection capital. Their value is not growth, but stability during uncertainty. Another major USA issue is inconsistent saving behavior. Many people start saving for emergencies, but stop midway due to temporary financial pressure, lifestyle upgrades, lack of clear goals, no automated system. A stronger financial system usually includes automatic transfers to savings, separate emergency accounts, clear savings targets, 3 to 6 months expenses, controlled spending habits, and debt reduction planning. Another important reality is that emergency savings improve long-term investing outcomes. When emergencies are covered, people are less likely to withdraw investments during crises. This protects long-term compound growth. Another corrected misconception: financial security is not built only by earning more, it is built by preparing for uncertainty. Americans who maintain strong emergency funds tend to experience less financial panic and more stability during economic or personal crises.
If you want to change your financial future, subscribe to our channel, like the video, and comment below with your next goal.